Hello and welcome to this episode of ESG Talk, your go-to source for insights and advice from leaders in environmental, social and governance. I'm your host, Andie Wood. Today we're discussing everyone's favourite topic, taxes. Tax is increasingly intersecting with sustainability. Governments all over the world are enacting tax policies to spur investment in cleaner energy, transportation and industrial production. There are also increasing regulatory requirements for transparency in tax reporting. Joining us today to discuss these important issues is Brett Weaver, tax leader for the ESG practice at KPMG US. Brett also helps companies use data to better manage tax risk, capture sustainable tax benefits, and where appropriate, tell their public tax story. Hi, Brett. Welcome to the show.
Thanks, Andie. Happy to be here.
So let's jump straight into this. It would be really interesting to hear us run through and explain this, but let's just start by stating that tax issues are increasingly important when it comes to ESG. Bit of a pause there for everybody to digest that. This goes well beyond regulatory compliance, though. I've heard you say tax can be both a driver and a measure of sustainability. So let's break that down for our audience. And let's start with the fun one. How can tax be a driver of sustainability?
Yeah, that's a great question. Certainly something that's getting a lot of attention by business these days. And it really is one of the principal tools. Tax, right, is one of the principal tools that governments use to drive sustainability behavior in capital markets and in industrial policy. So it really is tax incentives, right? And many governments are using them. The U.S. seems to be leading out, and I'm sure we'll get into that a little bit more. But that really is what's driving it, and it could be a stick and a carrot approach, right? A lot of incentives. That's the carrot out there that would incentivize investments in green energy and the like. And then there's also, the stick out there, right? Dirty taxes, so to speak. So taxes on, supply chains that maybe are not as clean energy driven, et cetera. So it really is a principal tool that legislators and politicians are using to drive sustainability.
We do see that kind of thing happening when we're looking to drive the money. So let's start with incentives globally. What kind of categories of incentive would you say seem to be most prevalent? For example, do you see more incentives for technology innovation or encouraging a switch to renewable energy or something else entirely?
Yeah, I think that's a really fascinating question because, in some sense, it's difficult to bifurcate the two, right? I clearly the focus and the attention, so much what we hear about is on conversion to clean energy, and certainly there is on innovation and advanced manufacturing, things of that nature that we're also seeing incentives in the tax space. But in some sense, it's kind of the same thing, a difference without a distinction, because much of what, if you get into the details around the things that are focused on advanced manufacturing, high tech in the supply chain, et cetera, much of that is really focused on moving to more of a clean energy, better and more efficient use of water, power, those types of things. Most of where you're going to find the benefit in the advanced manufacturing in the technology space is driven toward clean energy outcomes. And you look at carbon capture, for example, right? That's a very, very difficult technology to deploy, and we're getting better and better at it. But that's another example where developing capabilities around advanced manufacturing is also contributing to this transition to clean energy.
So would you say we're seeing more focus on the climate side of incentives, or are there other issues that are coming up when we're looking at government incentives around using taxes?
Yeah, by far, climate is the big gorilla in the tax sustainability space. It's not to say that there's not others out there, right? There's still more, traditional focus around communities, low-income housing, et cetera, and there certainly are incentives around those types of things. But most of the oxygen gets sucked out of the room as it relates to tax incentives for the energy transition.
Or possibly just sucking carbon out the room, but we'll see how it
There you
goes.
go. Well said.
So, okay, we've got all these incentives. So, how can companies then implement sort of these sustainable tax measures and avoid any sort of surprises maybe down the line?
Yeah, that is also a great question. And I think an area that companies really need to focus on, and as a general rule, do much better than they are now. I think what we see is, much of the effort around, supply chain in supply chain redesign for multiple reasons, certainly clean energy, but also a lot of the geopolitics and other issues that we're seeing. There's a huge focus today in most companies in really rethinking their supply chains and the way that they produce goods and services. Oftentimes, that's just not very coordinated within the organization, right? You've got different, supply chain managers that are doing different things. It's not even coordinated there. Oftentimes, the capital investment around that is something that's an afterthought, and very often, tax and legal are left out of the equation until the back end. That really can create some risks and is a loss of opportunity. I'll give you a good example. We're working with a company, not too long ago, where they qualified for some very, very significant government tax subsidies, and these would be refundable, credits, direct pay credits that really they were the size that they were going to pay for about half of their capital investment in advanced manufacturing, et cetera, all focused around clean energy. So they were counting on this, had big news releases and all the rest of it. Tax was really not involved until kind of the back end. And as we got involved, it turns out that by taking those refundable credits, it actually put them in a position where they might be subject to the new base erosion tax in the US, right? That tax that they didn't see coming because they took the credits, right, would essentially evaporate about half of the credits that they were planning on for their capital investment. Now, thankfully, tax was able to get into the game soon enough that they found a solution to that. But I think that's a really good example that if the tax department's not involved up front with these very significant supply chain decisions, that some of the incentives, or maybe on the flip side, some of the environmental taxes that maybe the supply chain group that's driving those decisions did not see could really jump up to bite companies in the back end. So a coordinated effort is really key.
Yeah, I was at a tax conference towards the end of last year, and I think there was a lot of discussion about how tax isn't necessarily one of the teams that companies necessarily think of immediately to bring in when they're thinking about their value chains, or they're thinking about maybe taking advantage of some of these incentives.
Yeah, that's exactly right. I just think it's hard in companies to, they're big organizations. There's a lot of organization structures. There's power structures, right? It's really hard to coordinate well, but there's a huge payoff where companies can figure out how to do this right.
So, having talked a little bit there about incentives, I think it's worth definitely looking at the other side of the equation. And there is one particular green tax that's been getting a lot of attention recently, and unsurprisingly, it comes out of the EU. They are implementing a carbon border adjustment mechanism, which is a mouthful in itself and provides us with another acronym for CBAM, for those who haven't heard it spelled out. So that's adding to this picture. So, I mean, it's obviously to do with carbon, but what is the purpose of that tax, and who is it going to affect?
Yeah, great question. In particular, because you're right. CBAM, it sounds mysterious and all the rest of it, and no one really understands it until you get deep into it. But it is really important, and I'm sure we'll end up spending some time as to why. The purpose of the tax is really to address, carbon leakage, and let's talk a little bit about that, right? Because this is a European Union directive, right? So it applies to the European Union, and it applies to imports of carbon intensive products. So we're talking things like cement, electricity, steel, aluminum, things of that nature, fertilizer. So for at least 2 decades, right, we've had the EU emissions trading system, right, where there's free emissions credits that were provided to various industries. If you max that out, you'd need to go buy additional credits on the system, or you could buy them at an open market. And that was all designed to provide a financial cost to carbon in your supply chain. That then being an incentive, right, for companies to really clean up their supply chains and have less carbon emissions. Well, that's great if you're in the EU and you sell in the EU. So you produce there and you sell there, then, that's probably works to some extent. The carbon leakage issue that we're talking about is those same products that we're talking about that would be subject to the ETS, the emissions trading system. You could go to countries that don't have those types of systems and that actually have very dirty supply chains and acquire the same materials at significantly less cost because they're not paying for these carbon credits, these offsets, right, et cetera. And so you could go import steel or cement or electricity at a much lower cost where they've been produced in jurisdictions where they don't have that. That's the leakage, right? Like the world, that works great if it's just EU centric, but you just go out of the EU and you pollute the environment in the same way and bring the stuff in at a lower cost. And so the CBAM, right? It's a border adjustment mechanism, carbon border adjustment. And what that means is if a company is importing steel, let's say, from a country where the production process is very carbon intensive, then there will be a need to report the amount of carbon emissions embedded in those products, both direct and indirect carbon emissions that are embedded. And then there'll be a tax levied on that that is designed to be the equivalent as if you were subject to the EU ETS. And so that puts everyone in the world on the same playing field if you are either producing and selling into the European market, or if you're producing outside but selling into the European market, you'll be subject to the same costs.
Although I don't know why they didn't call it a duty or a border duty, but it is basically an adjustment.
It is, and it's assessed at the border, right? Just like a duty. So, yeah.
Obviously, I mean, I think this does naturally follow. Critics are arguing that that could potentially lead to a rise in the cost of the goods. So, do you think that has effects on the supply chains? It sounds like it should have an impact.
Yeah, it definitely is having an impact. We're seeing that in so many ways. One of the things that we're seeing is that companies, number one, are looking at their supply chains to see what they can do to reduce the carbon emissions, right? Because this is a real financial cost. To give you some sense, looking at India, for example, which is a major importer of steel into the European Union, it's going to be somewhere between a 25 and a 35% border tax to import that steel from India, just given the nature of the production process generally in India. So we're talking, major costs to do this. So looking at how companies can reduce the carbon emissions in their production process and in their supply chains is big money, right? And so we're seeing that already, right? We're seeing companies invest in their supply chains, and that might be looking at new suppliers, and second and third tier suppliers in the supply chain that are cleaner, because again, the measurement of the carbon emissions is both direct and indirect. So you have to trace this completely through your supply chain. There's a huge issue around data in this tax ESG area that maybe something else we could talk about at some point. But being able to track that identifies where there is some pretty heavy areas of carbon emissions in the supply chain, and trying to focus on reducing that is really important. And then it kind of gets back to the discussion we were talking about earlier around cleaner manufacturing process, more high-tech manufacturing processes. We're seeing, for example, in the steel and aluminum industries, companies starting to switch to electric arc furnaces, right, rather than the more traditional, blast oxygen furnaces, right, because you can power that with electricity rather than the traditional carbon intensive process, and that electricity can be sourced from renewable energy. So it's things like that we're seeing companies already take massive steps in how they partner their supply chain partners, their manufacturing processes. And I'll probably stop there for a moment, Andie, because there's also things that we're seeing from government action and policymakers that I think is pretty significant in how they impact the supply chain. But I'll stop there to see if there's anything, because I know I've been droning on for a bit.
Well, I mean, I think one of the issues we've got here is that it's just such a large topic. Once at the beginning, I said it may seem a little strange to people that we're talking about tax in an ESG context. But obviously, once we start to get into it, it becomes more and more obvious that it makes sense, that it's really heavily involved. Now, you mentioned a lot about data and value chains there. And I think we probably do want to touch on that briefly before we move on, because it's a really big comment and issue for companies from a reporting perspective when they just look at their external transparency, which is something we'll come on to. So obviously, what you're talking about also suggests that a lot of that data is relevant on the tax side as well. And I have also heard some companies, again, at conferences talking about, well, maybe the tax team actually is a really good resource because they have a lot of information about suppliers, about what's happening in the value chain, and about which companies are being worked with and have data on those. Does that all sound like there should be some big conversation about all of this data happening together?
Yeah, Andie, you said it well. I'm not sure I can add a lot to that, right? It's you made the case. Tax, again, is another reason where tax should be involved with supply chain and business decisions around production, product design, all the rest of it, because of the incentives, but also a lot of these issues that we're talking about. And tax does have a lot of data that they've had to have for some time as it relates to the tax compliance. And it does dovetail nicely into what we're seeing as companies are looking at, supply chain improvement, maybe even supply chain redesign. There is a greater need for data and transparency, both to have more resiliency in the supply chain, but also for the regulatory compliance issues that we're talking about here, right? Carbon border adjustment, taxes, other like plastic taxes in the UK, et cetera. A lot of these are driven, by data. You need to understand the complete end-to-end life cycle of a lot of these products and be able to report them, because that's what drives, a lot of the tax issues. It's the same thing on the incentive side. Just a quick little anecdote there, right? I think as many people know, under the IRA, where there's some massive credits that are available for companies. Embedded in the IRA is, the U.S. government's own industrial policies, right? That those credits can triple, right? They can be 3 times the size of the base credit simply by using qualified apprentice, by domestic production, by looking at prevailing wage requirements, whether they were met. How are you going to prove that you get 3 times the base credit? Well, it's all data. You're going to have to be able to show that you met all of those requirements, on an employee by employee basis, essentially, right? So the detailed data that is needed to both comply for these environmental taxes, as well as to qualify for some of these incentives, as well as then just to get your goods across the border many times. And again, this visibility to supply chain goes back to, ethical working conditions, et cetera, where products are sourced. So there's just huge convergence around visibility of the supply chain and data.
You started to get into another area there, which is the IRA, and to start to talk about that set of incentives. We've mentioned the CBAM, that's out of the EU. Are there any other incentives that you're keeping an eye on, especially ones that maybe companies aren't using as much as they could be?
There's a lot that I think companies often miss, and it gets back to the theme, Andie, you've called out a couple of times, is just doing this on a coordinated level within companies will be a huge payoff for relatively minimal effort, even though it's not necessarily easy to do. And that's both in terms of incentives, as you mentioned, but also minimizing, environmental taxes. And I think it's important to look at it on both sides of that for particular companies with large global supply chains and selling their goods and services around the world. And it's because, different parts of the world operate differently, right? And I think the best way to see that is what you teed up. The United States is really loath to, use the stick approach. And you contrast that to the EU, they love the stick approach, right? So again, that's why we see the CBAM, et cetera. But the idea that we're going to get, something similar to a CBAM in the United States, I think is a stretch at this point in time. There's just not the political will to do it. But we've seen that we clearly have the political will to, have some massive incentives that IRA put out. Just to give some context to that, when IRA was first enacted, the estimate of the tax incentives that would be made available to companies for clean energy and a little bit of advanced manufacturing was just under $400 billion was what it was going to cost the U.S. Treasury. Well, I think we way underestimated the uptake of companies on those incentives. The most recent, estimates from JCT and OMB indicate that it could be up to 3 times that amount, well over $1 trillion, right? So that's the U.S. approach. They're throwing money at companies who are willing to do it and willing to take it. And so I think it is a holistic view of where you sell your products, where you source them, where you manufacture them, and understanding that in some of these regimes it's all about incentives, and in others it's all about environmental taxes. And managing that appropriately can be big money for companies.
So we've been talking primarily about what companies can do to take more advantage of incentives, how to think about taxes that are working more on the stick side of things. But I already mentioned that there is a third angle to this, which is there is the reporting side of things. And you've also said that taxes are also a measure of sustainability. So could you just explain that for our audiences?
Yeah, that's been another part of the tax sustainability discussion, right? Is again, tax is this tool that governments use to drive sustainability measures. But there's also this, I don't know, I think it's kind of a completely different perspective on tax, which is, there's a view by many that corporations have a responsibility that goes well beyond making money for their shareholders, right? And that they have a responsibility to the planet, to people, to customers, employees, and all the rest of it. And there's this broader purpose of corporations, and that leads us to the fair share of tax discussion, right? Are companies paying their fair share for all these various reasons? And that's really around this measure of sustainability question, right? If you're making tons and tons of money, you're highly profitable, but you're paying very little tax, I think that does raise this question of whether that particular company in that little hypothetical is behaving ethically and sustainably, right? With those types of tax practices. It leaves a really interesting question, which is, well, what is a fair share of tax? One thing I do know is I cannot answer that question. I think it's in the eye of the beholder. But you can probably spot companies that everyone would agree they're paying a fair share of tax, and you could probably spot companies where most people would think they're not paying their fair share. So it's a real issue, and it's a branding issue. It's a reputational issue that more and more companies are paying attention to.
Yeah, we do see there is a recurring type of news article, for example, X company has published their results. We went and had a look at what they disclosed they are paying in taxes. But on the other side, I've also seen companies that are starting to disclose quite lengthy, detailed communications and policies about how they view their global taxes on their sustainability site. So, how do you see, that push for transparency affecting corporate tax strategies and governance?
It is having an impact. I would say generally this push for greater transparency, and we now are in that world, it is driving behavior. This is something that I think in time will show, just in terms of we'll see the reported effective tax rates in companies, I think, be higher than we've seen them in the past. And it's not just transparency, right? It's things like the global minimum tax and things like that that we have in place. So it's a bunch of factors. I think even the supply chain stuff we talked about, right? More and more companies are doing nearshoring and they're getting closer to their customers. That's going to change their tax rate, right? Because a lot of supply chains have been organized in tax favored jurisdictions. There'll be less of that. So at any rate, we're going to see it where the effective tax rates of companies are going to move up. And I think we're already seeing it. Anecdotally, and this will be harder to see, is that we are working with a number of companies that are moving to less aggressive tax strategies in many instances. And that's because of, in part, the transparency, that is coming. And right now, it's been largely voluntary. Right. But as we all know, due to, I'd say there's three big areas that the regulators have jumped into, which is going to take away any cloak of what companies were doing around their tax strategies, right? And that is, of course, the EU public country by country tax reporting directive, right, that will come into play in 2025. Australia just recently, followed up with their rules. And if there were countries you thought you didn't have to report under the EU, I can promise you that Australia labeled them as countries you will have to report. Think Hong Kong, Singapore, things like that. So between those two measures, companies that are multinationals will have to do country by country tax reporting, and that's reflecting profitability, employees, capital assets, amount of taxes accrued, paid, all of that on a country by country basis. And then you can add on top of that the recent US FASB mandatory disclosures that will also kick into play at the same time for 2025. And those rules will not be country by country across the board, but they'll be country by country for material jurisdictions. And we're going to get information in the FASB reports that we did not and won't get in the country by country reports. And that's the permanent differences that are driving that effective tax rate on companies' 10Ks. We're going to see that at a country level. And you don't necessarily get those in the country by country reports. And the point being, you take all this data and you push it together, there's no place to hide. If you're aggressive on your tax strategies in a particular country, it'll be very evident.
So we mentioned at the start of the show that part of your role at KPMG involves helping companies to therefore tell that tax story. What does that actually look like in practice? And what advice would you give to professionals who are involved in sustainability reporting in relation to the tax?
Yeah, great question. I guess I like to start with two high level areas of focus, and that is, and that's again discussions we have with chief tax officers. One is know your audience, and two is don't do it alone. And what I mean by that is, each company's different. Some companies, they have, a top down, very focused drive towards sustainability. And that's a very important element as to how they do business. Many of them have investor groups that are very focused on sustainability. And so that's what I mean by know your audience, right? Because you probably want to tell a little bit different story if you're a company with that profile as to a company that maybe doesn't have as much of a focus on long-term sustainability. They're much more focused on financial metrics today. Their shareholders are much more interested in financial metrics, short-term financial metrics. And I think you tell a different story depending whether you're the first company, my example, or the second company. The don't do it alone piece is this is going to be very public, and the level and the depth of information that we just talked about that will be available to news and reporting agencies, to politicians who have a particular axe to grind in a particular way. Be very careful in terms of how you tell the story and the narrative that you put around the data that you must disclose from a regulatory perspective. So I think this entails, really the chief tax officer bringing a lot of information and potentially options to the C-suite. Like, here's the regulatory rules. We're going to have to follow them. Here's some options that we have. We can just barely comply. We can add a lot more. We can lean into this in a big way. That might even be a board decision, honestly, as companies look at what their public profile is going to be. But I think that's the important piece, and it'll be different for every company. I know there will be companies that will just do the bare minimum. And on the flip side, there will be companies that will want to lean into this and do even more disclosure. I think there's more the strategic, which is where most companies will fall. If the bare minimum is meeting your legal requirements and you look good, you probably stop there. But if the bare minimum makes you look like you're not paying your fair share of taxes, but in reality, you're paying a whole bunch of payroll taxes, property taxes, et cetera, you may want to voluntarily report that so that shareholders and other stakeholders have the complete picture of really how much tax you do pay. So it's going to be different for every company.
And I think that's a really good place to end, because that is a phrase that we often hear across all sorts of topics in sustainability. I think that one of the key lessons there for sustainability professionals is they might not have been first on your list, but it is worth going to talk to your tax teams. So Brett, thank you very much for joining us today.
My pleasure. Thank you, Andie.
Thank you for joining us for this episode of ESG Talk, brought to you by Workiva, the world's only unified platform for financial reporting, sustainability, audit, and risk. If you enjoyed this episode, please rate and review us on Apple Podcasts and subscribe for future episodes on Apple, Spotify, or YouTube. And we'll talk again soon.